Here we go. Okay, good evening, everyone. Welcome to another Wednesday night with Sequoia Enterprise Solution. So I hope that you guys got a good week. Since last week we talked about we have a new program that just launched. Not last week we talked about we talked about the property claim, and ever since then we have total 27 property submitted in to review, and Mr. Mike not yeah is it Mike Rose? Mike. I think our client is no, not a client. I think Justin is going to reach out to Tariq to talk about to schedule a call with him. So again, so that's what we can do on our platform. But however, this week we are switching gear a little bit. We will go back to talk about our main business, which is funding. If you come to our platform the first time, you can see we have many different type of funding that it's on our platform. Uh, in on a 3,000 level, there are two type of funding that we offer. The first one it's the um, real estate funding, anything that with commercial real estate. Now, when I say commercial real estate, does not mean that it's commercial building. We are talking about commercial loans. What is the difference? Commercial loan basically means that anything that is a business purpose. So, for example, if you're purchasing a residential property for business purpose, such as Airbnb, rental, corporate housing, things like this. That it's a business loan, and that is what we do all day long. So again, the one type of funding that we do it's business, commercial real estate. The other type of funding that we do it's business funding, which means that has nothing to do with real estate, has a lot to do with the cash flow of the business, such as SBA loan, working capital, things like this. So tonight we are going to talk about two type of real estate funding, which what we call the low hanging fruit. So for many people that come into Sequoia lending or come into commercial lending, we are very easily got excited about all these big deals out there. A hotel deal that worth about $10 million, uh, a, a retail that worth about $15 million, a construction deal that's about 20, $30 million. It's all good. All those projects are very exciting because of the number. But in reality, those big numbers are very it has its challenge, put it this way. It's not easy to put it together and it's not easy to get it close. So in our pipeline right now, we have so many deals that is above $10 million. Okay. But however, it does take time. So that is why a lot of the agent gets start to get discouraged. Um, just because when they bought in the deal, they expect that it's going to close next week. It's not going to. It doesn't work that way. So what I'm suggesting everybody to do is that if you really, really, really want to make money, that's what I got out from my mentor when I started the commercial lending. One of my mentor told me that Alan, if you really, really want to make money, pick on the low hanging fruit. So what is low hanging fruit? DSCR loan. What is DSCR loan? Everybody understand that type of loan. It's purchasing investment properties. Purchasing investment property. Now there are many ways to purchasing investment property, and one of the way is what we call utilizing the DSCR loan, which I'm going to talk about it tonight. I have this training many, 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 many times already. But why am I keep going back to it? It's just because this is our bread and butter. We close a lot of DSCR loan, and the interest rate is dropping. If you come to last year at this time, February 2025 at this time, the average rate is somewhere around 8%. Okay, we quote people 8%. Anybody know what is today's rate? Today's rate is somewhere, we quote people somewhere between low six and mid seven. Now, of course, we are assuming a lot of things, assuming the credit score is good, assuming that the LTV is good, so on and so forth, right? So, but however, as you can see, we are quoting people low six and mid seven compared to last year, averaging at 8% interest rate. So definitely people are coming out here to the interest rates drop. When interest rate drop means that it attract a lot of investors to come back on the market again. So that's why I want to share with everybody, hey, again, what this DSCR loan is. If you already know about this, great, fantastic. Go out there, generate more deals, right? So that's the first thing that I'm going to be talking about. And then after that, Mr. George Franco, is going to be online to share with us fix and flips. For those For those of you know, George, he himself is a lender. Before he joined Sequoia, we closed a lot of deals together. And long story short, he looked at our platform and he likes it, and he decided to join partner up with us and become one of our advisors in Sequoia. So let's get back to what we're going to be talking about tonight. Purchasing real estate using commercial loans. Now, why are we doing this? So I'm going to share with you what's going on in the market today. Why people purchasing property using business loans. And I'm going to talk about what is commercial loans, what is the application, who uses this type of thing. And of course, at the end of the presentation, I'm going to talk to you about the guideline. What do you need to watch out for? Okay, so this type of loan is the low-hanging fruit. A lot of people understand it. A lot of investor, when they start to invest in real estate, this is what they do. They go out there purchasing single-family homes, townhouses, condos for investment property to rent it out and collect the rent. And what the hope is that the rent is going to cover the mortgage and still has something left over every single month, have continuous income from all these rental properties. And at the same time, when the value of the property goes up, they make that is how they make money in real estate, right? So however, in today's market is a little bit different. Well, not different, but the reality of the market is this. Not everybody can go to a bank to get a loan. That is just reality. Why? Is because again, bank is a very, very conservative funding institution. They need to understand what you're talking about. You need to have a good credit score. You need to have good income. You need to have good DTI, LTV, so on and so forth, in order for them to give you a loan. Now, don't get me wrong. If you can go to a bank or traditional loan officers to get a loan, by all means, by all means. But then remember, first of all, if you want to become a traditional loan officer and got into this industry, you have to get licensed. That's number one, because now you're talking about totally different type of loans. You're talking about consumer loans. Okay, you need to get licensed for it. However, when you come into commercial lending, there's no licensing needed because it's a total different type of loan. It's a B2B loan. When you work with the traditional mortgage industry, you are talking about B2C loans. Coming over here is a B2B loan. So basically means that you, even though without a license, you are competing with a lot of real estate agents out there. Not real estate, but loan officers out there. And I'm going to share with you why when they come to us, it's a lot why investors is more favorites to come to our side of the world. But what is the market? What is the market doing right now? Reality is this: we are dealing with investors. We are not dealing with first-time home buyers. Please remember, we only deal with investors. Now, when it comes to investing, a lot of the investors, guess what? They might not able to show income. When you go to a bank, the first thing that they ask you is that, hey, show me your income, show me your bank statement, show me your tax return, so on and so forth. Because in the traditional world, they're based the loan on that person, personal assets, personal credit, personal income. But however, not many people can actually show that they have good income. Not necessarily means that they don't make any income. A lot of people make a lot of good money. However, because they're business owner, they know how to do tax write-off, so on and so forth. So on their tax return does not show that they make money. So once your income is not there, the traditional bank is not going to take you in as a client. So that's we see a lot of clients like this. It's just because they cannot show that they are making money. So that's one of the reasons. The second reason is that it's because of credit issue, right? So in the traditional world, you have this box right here. You have to have a 700 credit score. You have to have a 680 credit score. Once you drop 1 point, 2 point, they're not going to take you anymore. So many clients do have credit issues. Now, when it comes to credit, they're not just necessarily looking at credit. Don't get me wrong. A lot of people just say, "Oh, I have a good credit score." Good credit score sometimes does not mean that you can get a loan. We have clients that have credit score in the 700, 720, 730, whatever that might be. But however, I'm talking about in the traditional world, okay? They are looking at something called a trade line. Anybody know what a trade line is? A trade line means that every line of credit they will have, a car loan is a trade line. A mortgage is a trade line. A credit card is a trade line, so on and so forth. They're looking at how strong your trade line is. Okay, so even though you have a high credit score, some of the clients they do not use a credit card, and especially in some community, like for example in the Chinese community where I came from, a lot of my people they don't use credit card, they use cash. And when you look at their credit report, yes, they have high credit score, 700, 750, but they only have one credit card. So to a lot of lenders, that is very, very weak. So even though you have a 700 credit score, they might not
Hey,
even give you a loan. Okay, so
I got your message.
credit issue might be a reason that they cannot get a loan from the bank. And of course, high DTI. What does it mean? What does DTI stands for? Debt to income ratio. Debt to income ratio, meaning that in the agency side, again, a traditional mortgage company, they're looking at this ratio called debt to income ratio of you as a person. Debt to income ratio, basically, just like what I said, how much debt do you have and how much income do you have? Now, what happened? What happened? As an investor, you keep buying property, keep buying property, keep buying properties. So the more mortgage that you have, what happened to your debt? The higher your debt is. Okay, so your debt to income ratio will become higher and higher and higher. Eventually, you will not be able to get a loan from a bank anymore. It's just because your DTI is so high, unless you have so much money that you have so much money that deposited in that bank, that they might be able to give you a loan. But if you do not bank with that bank, and you just go to a traditional mortgage broker, most likely you're not able to get a loan when you get to a certain size of portfolio. And that is why a lot of investors, when they get to a certain number of investment properties, they would no longer be able to go to a bank, and they have to force them to come to alternative funding sources like us. Okay, so that is DTR. That's what they're looking for. And of course, timing. A lot of the investor, when you're investing in real estate, what happened? What do they say? They're saying that when you buy the property at the right time and the right price, you already make money. When do you make money when you invest in real estate? It's the time that buy, not in the future. But when you purchase it, if you purchase it right, you already make money. So to a lot of people, they look at a good deal, they need to get this thing done as soon as possible. Okay, as soon as possible. So still going to a traditional world, it takes time for them to process it. I don't know I don't know how long it takes now, but it used to be 45 days, 60 days to get it done. But coming over to our side, as long as the deal is clean enough, we should be able to get it done in 30 days. And of course, a lot less documentations. Okay. So again, so that it's what is happening in the market right now and why people will come to us. Now, let's talk about what is commercial loan. Okay. We are brokers, commercial brokers. We only fund business loans. So what are they? First thing first, when you come into the commercial side of it, the advantage is number one, we do not look at your personal income. Your personal income has nothing to do with buying this particular investment property. So that is one of the big thing. A lot of the client come to us is just because what did I say? They do not have a good tax return. It does not show that they're making any money. So that is a lot of them is concerned. But once you come onto our side, it it erased that concern. Don't even tell me about your income. And as a matter of fact, sometimes when we fill out the application, we do not even want them to fill out the application, the section where it said, what is your personal employment? Where do you got the money from? We don't want to see that. Okay, so again, because this is a business loan. So that's the first thing. That is the advantage. What do we need to verify though? Now, this might be the disadvantage for coming to commercial loan. It's we need to verify the down payment. How much down payment that we need? Somewhere between 20%. Extreme case is 40%. 40% your credit score sucks. You have the client's credit score is in a very challenging credit score. The property is in a rural area, then we might need you to put down a lot more down payment. But if the property is in a good metropolitan area, rented out good, the market rent is it's ideal, then probably 20% will be enough. But however, on a traditional mortgage, you might only need to put down 5%, 10%, much less down payment than us. But however, the 3%, 5% down payment, that is for primary residence, which we don't do. Now, I don't know. Again, I'm not on that side anymore. I don't know. I don't know how much down payment that they need. Probably they still also need 15% to 20%. So it's very similar to us. But on our side, we have to show that you have minimum 20% down payment. And not, in some case, in some states, I know that you need at least 25%. For example, like in Texas, because again, the tax bracket is pretty high in Texas. But however, if you're in other city like Florida, Maryland, Virginia, 20% will be more than enough. But so that's what we need to do. The commercial loan is that we need to verify the down payment. When it comes to commercial loan, we give you money for as long as you're not buying it for primary residence. You don't tell us that you're buying this property to live in. Once you tell us that we know that there's a primary residence, we don't do this kind of loan. Okay. Probably George is going to fill you in later on to show you why is it like this. As a lender, as a commercial lender, they don't like to know that people are buying property as a primary residence. So that's the only thing that we don't do. But if you're purchasing the exact same property for any other purpose, purpose, we fund that all day long. It could be condo, duplex, triplex, 4 units. Of course, we can go up to multifamilies, mixed use, so on and so forth. So there's many type of funding that we can do. In the traditional world, a lot of the loan officers that you talk to, most likely they can only do single family home. Maximum they can do 4 units, 1 to 4 units. The maximum that's what they can do. But other than that, their hands are tied. So on our side, you need to purchase property under an LLC. Okay, under an LLC. Now, understand that a lot of people wants to own asset under their own name. It just I think it's just because of personal pride. But however, if you do it right, if you talk to any financial advisor, I bet a lot of all the financial advisor will tell you do not put anything under your name. Put it into an LLC, put it in a trust. Today, I mean, literally today we met up with a trust attorney, set up a trust for our family, and basically they're saying that well, transfer everything into a trust because of what? Asset protection. Because of what? Privacy. Now, there's another good thing. When you buy property under your own name, what happens? That mortgage is what? It's going to show up under your credit report, your personal name, right? But however, when you purchase the exact same property under an LLC, what happened? There's no credit report. It does not show on your personal credit report because who is actually the one that borrowing the money? The LLC, not you. You are just the guarantor of that LLC, but that guarantor can be assigned to someone else. Today it might be Alan Wu is ABC LLC. Tomorrow I can assign that LLC to John Wu, Mary Doe, whoever that might be. So again, it would not show up on my personal credit. Okay, so that is another advantage for coming onto commercial loan. LLC does not matter again because you are using the LLC to just holding the property, so it does not matter that LLC have any history or not. You can literally set up an LLC today and hold that property and use that LLC to purchase a property tomorrow. There's no question asked. Okay, so that is another advantage. And I said it already, using a commercial loan, purchasing under LLC is for asset protection. So now what do we look at? Now, oftentimes you hear we say DSCR, DSCR, DSCR. Now, this is the in commercial lending, this is the most important word or abbreviation that you need to understand. It's called DSCR. Whether you're buying a property or you're doing a business loan, whatever that might be. All the lenders looking for DSCR. DSCR basically is telling the lender what is the cash flow of that building, of that property. And that's the reason why we do not look at your personal income. We are looking at the DSCR, debt service coverage ratio. That's what DSCR stands for. So basically, whatever the the income from that building, can that income cover the debt? So that is what it means. So if you want to really get into more technical, that is the formula right there. DSCR equals to the net income divided by the debt. What does it mean? So the net income is what? What is the net income? The net income is the rent that I'm getting. So everybody know I'm purchasing investment property. My let's say let's say a $300,000 property, right? So I can rent it out for $2,500 a month. So my income is what? $2,500. And what is my debt? What is my debt? My debt including what? Tax is debt. Insurance is debt. What is the last one? Mortgage is the debt. So now, what kind of ratio are we looking for? We're looking for minimum 1.0. Now, let me ask you this. When your income divided by your debt equals to 1, are you making money or are you losing money? You're not making money. You're not losing money because your income erase the expense. That's why now it's 1, right? However, hopefully the logic is that when you buy a piece of property, you're not going to just buy it today and sell it tomorrow. You're not flipping the properties. I'm talking about DSCR, long-term hold. So normally people were holding a property like this for minimum 5 years, 5 to 10 years. Okay, so the hope is that 5 years down the road, that $300,000 property will increase in value. Increase in value. 5 year down the road is probably 320, 330, right? And your rent is going to increase also. But what happened to your debt? Most likely your debt is not going to be changed that much. For example, I mean, probably your tax will increase a little bit. Probably your insurance will increase a little bit. But what about the mortgage? The mortgage is the same because normally you're getting a 30-year mortgage, right? So the mortgage is the same. So that what does that mean? The DSCR will become bigger and bigger and bigger and bigger. It's not 1 anymore. The next year probably will become 1.05. Year after that, the second year will become 1.1, so on and so forth. You got the idea, right? So most of the lenders are looking for minimum 1.0 DSCR. As long as you hit that 1, you're okay. Now, in some extreme cases, we can even go as low as 0.75. So let me ask you another question. When the DSCR is 0.75, what does it mean? It means that you need to put money into that building every single month. Think about this, right? Every single month, you need to put money into that building. But however, why the lenders are willing to do that? They are looking at your experience. And that is why on our side of the world, experience, they reward you when you have so many different properties. On their side, when you have a lot of property, what happened? They don't give you a loan anymore. But on our side, the more property that you have, that tells the lender, the more experience that you have, they're willing to give you money to risk a little bit more on property like this that with DSCR that is below 1. Okay, so again, that is what the lenders are looking for, DSCR. Now, if you have a DSCR 1, most of the time we run into a DSCR somewhere between 1 to 1.25, somewhere around there. And if you within that range, I bet you will get the best rate out of it. Okay, so that's what DSCR is all about. Now, um, what do we need? Now, do we need? There are 5 things that we need. 5 things. Excuse me. There are 5 things that we need to in order for us to give you the pricing. Remember the DSCR. Okay, income divided by debt. So let's talk about it. The first thing, what we need to know is what? We need to know what is the market rent. What is that? That's the income. Now, if the property is vacant, is that okay? Absolutely, it's okay. No problem. Because we can go out there to do an appraisal, and the appraisal will tell us what the market rent is. Now, on the other hand, if you're purchasing a property that already have a tenant in there, that's fine. We will just use whatever the current rent is, what the actual rent is, right? So market rent, that's the number one thing. That is your income. We want to know what is the insurance and taxes. That is part of the expense. We want to see your credit score. All right, credit score. Even though you're purchasing under an LLC, but you are the guarantor of that LLC, the lender will still want to see your credit score. Now, this type of loan is personal guaranteed. Even though you're purchasing under an LLC, because you are the principal of that LLC, you are personally liable. You're personally guaranteeing that loan. If the LLC is not paying the mortgage, then you will pay the mortgage. So we do need to see your credit score or your credit report. Okay. Of course, we need to see the address. Now, why do we see the address? Because we need to know what the zip code is, and believe me or not, different zip code will come out with different pricings. Okay. So again, the pricing in California is different than the pricing in Texas, and it's different in Chicago, and it's different in DC. So we need to see what the address is. Now, oftentimes we have agent come to us saying, "Hey, Alan, I have a client that is going to buy a house." Again, we don't know where he does not have a property yet, but we just want to see if he can get a loan. So in that case, at least let us know where is he buying the property from. Give us a zip code, then at least we can figure that out. Give him a rough idea what the loan amount looks like. Okay. Of course, we need to know what the market value is, how much that property was. So those are the things that we need to know in order for us to provide um, a quote for our client. So each one of us already have the scenario form. So from your scenario form, fill out that 1 to 4 unit investment property. If you look at those questions carefully, we design those questions. Once you answer those questions, the more accurate that you answer those questions, the more accurate the number would be, or the quote would be for you and your client. Now, what about the guidelines? So ideally, we want to see 660 credit score and above. If below that, can we still do it? Absolutely, we can still do it. But however, it's not favorable to our client. The interest rate will be high, the LTV will be low, the fee will be expensive. So in that case, if the credit score is below 660, normally we will suggest our clients to go fix your credit first. And we do work with some very good credit specialists that can help our clients to fix. Okay. So if, of course, if they already have some credit specialists, by all means, fix their credit first, get up to 660. Now, normally I would like to tell people to get up to at least 680 because again, our credit score fluctuates every single day. So one day it might be 680, the other day it might be 630. So again, it might be 660 or below the line. So keep it at 680. Okay. Now, what will happen at 680? Above 660, when you do a purchase, we can go all the way up to 80% LTV. When you do a rate and term refinance, we can go all the way up to 75% LTV. And if you want to do a cash out refinance, take cash out from the property, 70% LTV. Now, 80% is the max. Now, we do have clients that can go 80% cash out for investment properties, but not many of them. We only have 1 or 2 lenders that can do something like this. So normally we do not advertise that we can do 80% LTV on cash out. Normally on a safe side, we tell them that's 70%. And on top of it, the higher the LTV, guess what? The higher the interest rate. So give you an example. Let's say if you get 75% LTV, your interest rate might be at 7%, for example. But if you can drop 5%, your LTV down to 70% LTV, hey, your interest rate might drop a quarter point, 6.75%. So there's a lot of and again, a lot of people. That's why we want everybody to understand it. The higher the leverage, the higher the interest rate. If you want to get a better interest rate, then the lower the leverage. Okay. Now, what kind of documentation that we need? Pretty simple. We want everybody to get the loan under an LLC. Now, there are exceptions. There are some states that will allow you to purchase a property using your own personal name. But again, on our side, we strongly do not suggest you purchase an investment property under your name. Set up an LLC, much easier. Tell your clients to set up an LLC. Use the LLC to purchase it. So we need to see the entity doc of that LLC. What is entity doc? EIN number. You get an EIN letter from IRS, and you will have the operating agreement. Even though it's just a one member LLC, we still want to see your operating agreement. It's very easy to do. When you set up an LLC, either you ask a CPA to do it or you do it yourself. There's so many things online that can help you out. So operating agreement. And another thing that we need is article of organization. Okay, article of organization. Now, of course, set up an LLC is the easiest thing to do. But however, we see people that set up S corporation, C corporation, trust, and all kind of stuff. They're all fine as long as it's not your personal name. We have no problem whatsoever. Okay. Now, also we have client asking us that, hey, Alan, I already have an LLC. I own a restaurant. I already have an LLC. Do you suggest me to use that LLC to buy a building? Again, to me, I don't care, right? But I would suggest them not to use your existing business to carry in another property. For example, if you have a mechanic shop, right? ABC Mechanic Shop LLC, you're already generating income through that mechanic shop from your own business. Now, all of a sudden, you add another real estate into that LLC. Now, that real estate also generating income. That is going to create a lot of confusions for your CPA. So might as well just break them into two different LLC, much cleaner that way. Okay, so that's just my personal opinion. But again, if they want whatever LLC that they want to use to purchase, we really don't care, right? So we do need to see the entity doc. We want to see their ID. We do a lot of foreign national loans. So if they don't have a US ID, I need to see the passport. I need to see the visa. Okay. I want to see the asset statement, meaning that it could be a bank statement, it could be asset mutual fund statement, stock statement, whatever that might be, that shows where the deposit come from. In some cases, we want to see. Let's say they're purchasing a property. I want to see where the money is. Now, if you already own a property, sometimes, not all the time, sometimes you want to see that you deposit the rent. And especially in some extreme cases, for example, we have clients that owns mansions. They're collecting like $50,000 a month on their mansion. So the lender would like to see, are you actually collecting that $50,000? So as a statement, that's what we need. If you are renting out, if you already own the property, or if you're purchasing a property that has a tenant in there already, so in that case, we want to see a rental lease. Okay, so pretty much that's all we need from the client. There's no income we ask. We do not ask for income. We do not ask for tax return, right? So those are the things that we need to get from the client. And besides of that, we also need third party reports. For example, like appraisal. Definitely, we need appraisal reports. We need title and we need insurance. So in summary, those are pretty much all the documentations that we need from the client. It's a lot less simpler than a traditional side of doing business, and that is why a lot of the real estate agent, love to start partnering with us. It's just because much easier for the clients to get through, much easier for the clients to get their loan. And also there's a lot more flexibility on our side to push the envelope to get the loan done. And I mean, quite frankly, there's so many what we call exceptions, exceptions that we experience with so many different type of clients. So that is one good thing about doing using commercial loan is that we can always ask for exceptions as long as it makes sense. So I see that you have a question, Tom. So let me after this two slides, then we can ask. The next thing is that application, who use this type of loans? Again, people that cannot show income, foreigners. Some bank can do foreign loans, but not all banks can do it. But we do a lot of foreign national loans, portfolio loans, meaning that they have many different type of many different. They have multiple properties and they want to lump everything into one blanket loans. Investment, Airbnb, short-term rental, home care. Now, home care, there's something surprise. We have done quite a few loans for uh, home care business where they purchase investment properties and turn that investment property into a home care where they will host patients or elders who live in that building or in that property, right? So bank turn downs, meaning that not bankable. Client goes to the bank doesn't like it, turn it down, come to us. Let us take a look at it. So again, those are all the different type. That is the what I want to share with everybody is that the DSCR loan we are funding a lot of them. There's a lot of potential with this kind of product. It definitely is the low hanging fruit. If you really, really, really want to make money here, I would suggest you to look into the DSCR type of loans. And the next type of loan is definitely the fix and flip. We've done a lot of fix and flips. I think Mr. Benny Miller right here hit a jackpot. All he had is just one client, I can tell you, Benny. All he got is just one client. And guess what? We already closed at least 10 deals with this client. 10 deals. I mean, every single month, this guy would just come back and get another one, come back and get another one. Every time when he closed, and then Mr. Benny Miller would get a loan out of it. So definitely fix and flip is another product that we close a lot. And I leave that to George. George is an expert on something like this. He himself is a lender, as I mentioned to you guys many, many times. So I will have George to share with everybody what that fix and flip is all about. We have some crazy program. We can even go up to 100% fundings and so on and so forth. But George, the floor is yours. Share with us what you got.
Thank you, Alan. Appreciate it. I want to add a few more things on the DSCR side, just because we do DSCR and fix and flip. We do have programs where there's no minimum credit score. So in those cases, it's not going to be as high as 60 to 80%. It's going to be 50%. So we have lenders that actually do 50% of the purchase price, no minimum credit score, in a DSCR side, of course, with a higher interest rate, but those are available. So if someone doesn't have the right credit score, they can still qualify for DSCR. It'll just be more money down and a lot higher rate. Also, we also have loans for ITIN uh, uh, ITIN borrowers. We also have people that under a DACA program, and also DSCR is commercial as well. So, Alan, I know you mentioned a lot of residential and investment property rental stuff, but DSCR also qualifies to some of the bigger buildings and bigger structures as well. Also, one thing you touched upon is owner occupied. That's one thing we don't do. And a big reason for that is owner occupied is heavily regulated. You have to be licensed to do that. Sequoia as an entity is not licensed for owner occupied properties, and so as a result, we can't fund them. So if that comes to us, we have to turn it down or refer to a licensed individual to get that done. It must be business purpose. That's why a lot of times these lenders will have the borrower put it into an LLC name because it lines everything up with a business purpose loan, and it's not a consumer loan. So very important to make that distinction, because if someone comes to us with owner occ, we have to shut it down or turn it away. On the fix and flip side, we're doing a lot of exciting things. I mean, as Alan mentioned, we do a lot of DSCR, a lot of fix and flip. The money out there is getting very aggressive. Every week we're getting new programs from different lenders, different private groups that are saying, "Hey, send us your deals, send us your deals." And so as a result, we have much more lenders doing 100% funding, as Alan mentioned, meaning 100% loan to cost. So 100% of purchase, 100% renovation. All you have to do is bring closing costs to the table, and one particular lender will actually defer payments, and so there are no monthly payments throughout the whole process for 12 months, which is great. When you think about that, it's you don't have to worry about a monthly payment, no monthly mortgage. All you have to focus on is getting the property renovated and sold. Also, a lot of lenders are going higher. If they're not doing 100%, do it up to 95. We've seen some do 97. So the bottom line is a lot more leverage in this current market than maybe a year ago, 2 years ago. That money is getting, again, very aggressive, very bullish in terms of putting it out. And again, it's really good for brokers and really good for borrowers. So it allows you, the loan officer, the broker, to say, "Hey, Mr. Rehabber, we've got some great programs for you. Let us know your situation. We'll be able to help you out." We also have loans that don't require appraisals. That's a big thing. On the DSCR side, every single loan requires an appraisal. There's no two ways about that. You have to get that. Whereas on the fix and flip side, if a loan has to close quick, because fix and flip is a speed game. DSCR, you have 30 to 45 days to get everything done. Fix and flip, a lot of times rehabber has to put in a really good offer to get that deal, and they have to promise that seller that they can close in 15 days, 10 days, whatever the case is. We have lenders that can accommodate that. So no appraisal, they'll do all the evaluation in-house, meaning they'll pull their own comps, they'll do their own research and put out a term sheet based on that. Again, that's speed that allows us to close a lot quicker. So again, it gives you a lot more flexibility in terms of if someone says, "Hey, I got to close fast," hey, we can do it. We can absolutely do it. Also, another thing is no experience. Maybe a year, 2 years ago, a lot of rehab lenders are turning down first timers. Now we have a lot more programs for first time rehabbers. They can get up to 80%, meaning they only have to put 20% down. the lender will cover 80% of the purchase price and 100% of renovation, which again, that's a great deal given that they've never done this before. It's their first time. All they got to come up with is 20% plus closing costs, and we get them a deal. Now, again, it depends. That's not a guarantee. I say up to 100, up to 80, up to whatever. It really depends on the deal. The lender has to see the credit score, the experience, the asset. A lot of things play a part in what that pricing and that those terms will be. But again, we need to once you go fill out that online submission form Alan mentioned, that you go on the website, you fill out the form, it captures every single thing we need to be able to put out some terms for you guys. Um, we had a situation like us talk about first time investors. Great, we had a gentleman that came to us, great credit, great liquidity, but the issue was that he was going for a very large budget. I think the budget was going to be $500,000, and his previous renovation was going to be 75K. So a lot of lenders didn't like that, and so it was turned down. The issue is that you have to make the risk relative to what that borrowers bring to the table. So a first time investor can't come to the table and say, I want to renovate $1 million home and put in, $500,000. It doesn't work that way. First time investors are typically going to be limited to like, mid-range rehabs, maybe cosmetics or mid-range, maybe up to maybe 30, 40, 50K, somewhere in that ballpark would be ideal for a first timer. But that's again the realistic expectation. Sometimes people come to us and, that doesn't happen. They don't have that experience. So we recommended a partner with someone. We have creative ways of doing that. Some people come to us, and that's exactly what we told this gentleman here who was looking for that money. If you have someone that can partner with you, yeah, you got great credit, you've got great liquidity, you've got money, but you don't have the experience. So hey, if you find someone to partner with you, maybe a GC or maybe someone else that has rehabbed many properties in the past, absolutely, they can come together, and we have programs where you can join forces, and that way the person with the experience comes to the table with the person with the credit and the money. They come together and are able to actually get some of that good pricing. So that's some of the things we have going on in the fix and flip side. Also, I have to say we over the past few months or so we've talked to a few equity partners that can bring money to the table. So it's not just debt. A lot of the fix and flip loans are required to bring money to the table. 20 to 10 in some cases. Closing costs. A lot of times the rehabber doesn't have it. They may have a great deal, but not necessarily the money to close. So we've actually engaged a few private individuals that have money that are able to come to the table, private groups and private individuals. So if you have someone that comes to you and says, "Hey, I got a great deal. I just don't have the money to close." Again, you have a product now. We can talk to them. We can introduce them to our equity people and maybe able to get something done. Also, transactional funding is something else we're offering, where it really works well for wholesalers. If a wholesaler needs to close a transaction to sell to the end buyer, it's called A, B, B, C type transaction. We have lenders that can do that as well. So again, we're very excited about what's opened up over the past year or so to help the fix and flippers, to help the fix and flip market. Definitely are excited to work with you. Any questions whatsoever, please feel free to give me a call, give us a call, send an email, text message, whatever. Be happy to talk to you guys more about this in depth.
Yeah, feel free to ask any questions, and thank you so much, George, for your insight on this. And to us, we feel that the market is definitely going back to before COVID. At that time, I mean, we are closing deals left and right, but once COVID hits, the interest rate goes up, so on and so forth. It actually, I would have to say that for the last 3 to 4 years in commercial lending, it slowed down a lot. But now we're actually seeing that starting. I mean, we are so busy on January. We already have so many people calling us. We've submitted so many different type of deals, and personally, I really feel that we are actually heading to the right direction. The interest rate is dropping, uh, because you can see when the economy is not good, the lender is tightening up their underwriting guideline. They make it so difficult to get a loan. But in today's market, the lenders actually losing up a lot of the guideline. We have lender now, on a daily basis, keep calling us saying, "Hey, Alan, I mean, we used to be only to do 70% LTV, and now we can do a 75%. We used to only do a 700 credit score, and now we can drop down to 660." You can see they're losing up a lot of guideline, and which tells us that the market is here. right? So looks like there are a few questions right here from BG. Oh, okay. But yeah, if you have any question, feel free to unmute yourself and talk, right? So Tom, I saw that you have a hand raised before. So go ahead, Tom.
A quick question on the appraisal. If a borrower has a recent appraisal, will will most of our lenders accept that, or do they want to order their own appraisal?
George, you want to come in?
Sure, sure. If it's ordered through an AMC to another lender, for example, then that typically is acceptable. Typically, there's nuances between lenders. Most will agree as long as the lender transfers that to them. That's fine. And if they use the same AMC, if AMC being an appraisal management company, these are the companies that lenders use to order appraisals. And so usually that's the case. Now, if the borrower orders the appraisal him or herself, typically that's going to be a no, and they're going to require a new appraisal.
Right.
And let me jump in
And the
here.
B
Now, if the uh,
and the BPO is out of the question, I'm sure.
I haven't seen a DSCR with a BPO yet. On the fix and flip, maybe, but DSCR, no.
yeah.
Yeah. Okay. Thank you.
And let me jump in on that appraisal questions that you have. Now, if the client come to us and we go to one lender and order the appraisal, and if for whatever reason that lender cannot get it done and we have to go with another lender, it will be very easy for us to transfer that appraisal to the other lender because we have good relationship with this lender. If they cannot close, and I can just tell them that, hey, John, Bobby, give me a transfer. They're okay. They would not hold us hold hostage against us. But however, if the client went to another broker, get the appraisal done with another lender, which we don't have any relationship with, and now you ask that lender to try to transfer to us. Oftentimes, our experience is that it will take them forever to get that thing transferred. So, might as well, in some cases, let's say if you're doing purchasing a property, might as well have them to just order another one and much quicker. Because if you're under pressure, under time pressure, and if the other lender is not cooperating, there's nothing much you can do about it. Even though we like what the number looks like on the appraisal, if they cannot transfer to us, we can use it. So, anyone else? If not, then let me share with you what happened. So, this is what's going on. We do have a spring challenge. Spring is here. Okay. Um, from now on, from now you submit a deal. We're talking about DSCR deal. Okay. DSCR deal. Not working capital, not SBA loan, none of those things. Because I want everybody to focusing on the low hanging fruit. You submit a DSCR deal, you close it by the end of May. So we have half of February, March, April, and May. 3.5 months. Okay. 3.5 months. You close as many deals as you want, but collectively, if you close $500,000 worth of DSCR loans, on top of the commission that you're supposed to get, you're also getting extra $1,000. That's on top of whatever you get. Now, what we are seeing is that in general, we are seeing is that average size of DSCR it's approximately 300,000. So you are talking about two loans. You close two loans, you still get your commission. Now, how much are you getting? So normally for a $300,000 loan like this, we normally charge 2 points. So meaning that for a $500,000 combined loan amount, the total commission that comes into Sequoia, it's 10,000. Okay, conservatively. And your share is 46% of it. So which is nine 4,600 dollars. $4,600 plus extra $1,000. So now you're making 5,600, no, not for, yeah, 5,600 for a $500,000 loan. Now, if you close 1 million, we give you 2,000 extra. Okay. So again, that is the promotion from now until the end of May. So guys, let's go for it. Free money on the table. We love to give to as many people as possible. So pretty much that's all we have. Hope that you again, this is not something new. I'm sure that a lot of you heard this type of training already, but I just want to re-emphasize everybody. Even though Sequoia is expanding, many of you see we have new product and services onto our platform. We have, I mean, last week we launched a new service, which is a real estate claim. You guys saw my paycheck, right? So again, even though we're expanding, but back to the basic. The basic is the basic. What is the low hanging fruit? To me, this is low hanging fruit. If you can just do one deal a month, that is 12 deals a year. 12 deals a year, that will put you in a six-digit income. What wow, you guys can do the math, right? So that's all we have. Any questions, comments, you want to jump in? Feel free. We have a few more minutes. If not, then I'm going to just to, call it a day. Anyone else? Going once? Twice? All right. Well, again, thank you so much, everyone. Now, next week, come back next week. Stephanie from Hanover Bank is going to be here again on session 2 on SBA loans. So she was on our platform in January. So Stephanie is going to committed to come on to our platform once a month. So she will be here 12 times this year. She already did it one time on January to talk about SBA basic. So next week she will be back to talk about more detail on SBA loans. So again, ladies and gentlemen, thank you so much. Until then, I see you next Wednesday night. Good night.